Hey there, it's J-Rod here and welcome to Stocks That Rock. Today, as promised, I'm going to tackle some of your burning questions in a new Q&A video. All right, first question comes from Derek in Portsmouth, Virginia. He asks, should I be a seller of stocks in September and should I be concerned about a big sell-off? All right, great questions. I'll answer your second question first. I think we're due for a pullback after a rip-roaring year so far, but honestly, without a massive drop in the efficacy and availability of COVID vaccines, I don't think we get a massive drop in stocks. I know a lot of Wall Street talking heads are calling for a 20% drop in stocks with COVID and China risk, but with U.S. corporate earnings growth remaining strong, along with falling unemployment and inflation, I think the future looks brighter than bleaker. In terms of price action, I think what's more likely than a bear market is that we see a 10 to 15% total correction for each of the big stock benchmarks, the S&P 500, the NASDAQ, the Dow Jones, to basically pull back to their 200-day moving averages, and then we resume the upward chug for stocks. Now, to your second question, here's the scary truth. Stocks typically suck in September, like seriously. Over the last 20 years, the S&P 500 averages a decline of nearly 1% in the month, and it's only positive about 55% of the times. By far, the worst month of the year for the stock market. 2021 thus far has been no exception. Stocks are definitely following September script. Even better still, the second half of the month is the worst part returns-wise. The market normally peaks mid-month and then sells off. That's depressing, I know, but there is a silver lining. September is often a fantastic buying opportunity. Since 2001, the S&P averages a 1% gain in October and a roughly 2.5% pop in November. Shares normally pop in October from the start of the month through Halloween, and in November, shares typically consolidate and rip higher starting just before Thanksgiving. So if you're looking to get the biggest bang for your investing buck, you actually want to be a buyer right now over the next 2 weeks and basically hold through the end of the year. All right, next question. Online sports betting stocks, are they a good bet right now? From Nestor in New Orleans. Hey there, Nestor. Yes, but as a speculative long-term bet. It's kind of another good news, bad news situation. Personally, I'm bullish on the gaming trend, but there aren't many pure plays on online sports betting. So by owning these stocks, you're also getting exposure to casinos and racetracks, which are having a tough time still with attendance amid the pandemic. And you've also got China risk baked into these gaming stocks, as many casino companies have locations over there in China that are taking a beating right now over the government's crackdown on a range of different businesses. I think both of these risks are short-term, but they're going to apply downward pressure on the bigger names. But the good news, if you're a gaming bull and you have a strong stomach, this pullback offers you a fantastic opportunity to get into these stocks. Here are a few names individually that I like. 2 online sports betting companies, Red Rock Resorts, ticker RRR, and Every Holdings, ticker EVRI. Both of these stocks are big players in the online gaming and sports betting space, and both names are in strong uptrends and have pulled back nicely for great points of entry. I also like DraftKings, ticker DKNG, which is both a play on legalized sports betting and the very popular daily fantasy football market, of which I'm a big player in fantasy football and daily fantasy. Momentum's a little less strong on DraftKings, but I like it as a buy on a pullback to the 200-day moving average. But overall, if you can stand a little volatility, scooping up sports betting stocks now could pay off big down the stretch. All right, next question comes from Annette in Reno, Nevada. With new car sales sinking, are EV companies still a buy? Great question, and the answer is absolutely. Look, here's the reality. Electric vehicle sales are booming around the world. In the last 2 years alone, new EV car registrations have nearly doubled to 3 million registrations. And while EV penetration has been slower in the US thanks to cheap gas, we've already seen a record-breaking year of cumulative EV car sales through the second quarter. That uptrend is here to stay. I'm extremely bullish, along with my colleague here, Ray Blanco, on long-range battery technology. And as these million-mile batteries hit the road, we're going to see an explosion in overall EV car sales. So yeah, they're definitely still a buy to me. In July, I highlighted the Rockin EV stock Aspen Aerogels Incorporated, ticker ASPN. They're a company that makes battery insulation for EVs. And since I put that pick out, shares have gained as much as 30% and definitely still a buy here. I also like nickel miners like Glencore, since nickel is a key component in batteries and demand is far greater than current supply. And I'm still a big fan of Ford, which in addition to ramping up their own line of electric vehicles, such as the EV version of the F-150, they've got a massive stake in the hot IPO of electric automaker Rivian, which is targeting a valuation of $80 billion. Ford's stake in Rivian alone is worth 2 or 3 times Ford's stock price. To be fair, the stock suffered because of supply chain disruptions, but their loss is really your gain. You can basically pick up shares of the battered but rebounding Ford at $12 and get Rivian shares for free when they IPO. So that's all for today, but if you want to get your question answered on my next Q&A video, leave a comment on the video below or shoot me an email at askjrod@stpaulresearch.com. Finally, if you dig my content, please hit the like button and subscribe to the Rich Retirement Letter YouTube channel so you never miss out on one of these videos. Thanks again, and for Rich Retirement TV, I'm J-Rod, and I'll see you next time.